The Fed is trapped between spiking oil prices and a weakening economy, a classic late-cycle signal. According to Ben Cowen, this environment mirrors previous midterm election years, where Bitcoin saw a temporary pump before a major breakdown later in the year. He believes we are in a simple counter-trend rally. Meanwhile, CryptoRover's technical analysis supports this caution. He's spotting a dangerous bear flag forming and points to a massive liquidity pool between $65,000 and $68,000. He believes the real bottom is still 50 to 100 days away.
In the latest video from Ben Cowen channel, he explains that the Fed is in a tough spot following the recent FOMC meeting. Spiking energy prices, a classic sign of a late-stage business cycle, are making it difficult for them to cut rates, even though the labor market is showing clear signs of weakness. He points out that various metrics, like hires and job openings, are trending down, suggesting a recession could be near. Cowen argues that we are in a late business cycle, a point supported by his custom charts that track economic indicators. Historically, this environment, marked by rising oil prices due to geopolitical issues, precedes an economic contraction. For Bitcoin, he believes the recent upward price movement is just a counter-trend rally within a larger bear market, a pattern he's observed in previous midterm election years like 2014, 2018, and 2022. He suggests that after a temporary pump into March, Bitcoin is likely to break down later in the year. Rather than trying to predict the end of the well-established four-year cycle, he thinks it's better to stick with it until it's definitively broken. Ben Cowen's analysis of the Fed being trapped by stagflationary pressures holds up well against current conditions. The March 2026 FOMC meeting confirmed this difficulty as the Fed held rates steady, acknowledging the complex situation created by a weakening labor market and a simultaneous energy price shock. Recent data shows gas prices have surged and producer prices have risen faster than expected, directly supporting Cowen's thesis that inflationary pressures are boxing the Fed in. The geopolitical situation he pointed to as a catalyst for oil prices has indeed escalated, with conflicts in the Middle East pushing Brent crude above $100 a barrel and creating significant supply-side risks. This macro environment validates his concern about a late-stage business cycle. From a Bitcoin perspective, the price action has mirrored the cautious sentiment, with a recent rally stalling at major resistance. This aligns with Cowen's theory of a counter-trend rally rather than the start of a new bull run, as the broader market remains fragile and dependent on these larger economic forces.
In the latest video from CryptoRover channel, the host breaks down the predictable Bitcoin dump that happened right after the FOMC meeting. It turns out this has been a consistent pattern for the last 6 meetings. He mentions that he was hoping for a slightly higher price to enter a short position around $76,000, a level he sees as major resistance. Right now, he's watching a dangerous-looking bear flag pattern take shape. There's also a significant cluster of liquidity building up below the current price, somewhere between $65,000 and $68,000, which suggests Bitcoin might dip down to grab it. He's not convinced we've hit a true bottom yet, as he's not seeing the right kind of bottoming formation. His strategy is to wait for a potential drop to the $60,000 zone, where he has large buy orders ready to go long. He believes the real cycle bottom might not form for another 50 to 100 days. The analysis presented in the video, focusing on the post-FOMC dip and the formation of a bear flag, aligns with the cautious sentiment currently seen across the market. Recent hot inflation data, specifically the Producer Price Index, PPI, has amplified concerns that the Federal Reserve will maintain its hawkish stance, which typically pressures risk assets like Bitcoin. This macroeconomic headwind supports the video's technical thesis for a potential move lower. While the speaker focuses on liquidity pools below, it's also worth noting the significant role of ETF flows. Recent data shows that after a period of strong inflows, any slowdown or reversal in this trend could remove a key pillar of support for the price. Veteran trader Peter Brandt recently highlighted a similar, ugly bear flag pattern, adding weight to the speaker's concerns. However, the market structure is complex. Strong institutional buying and spot-led demand have been noted, which could counteract some of the bearish technical and macro pressures. The $60,000 level identified as a buying zone is a critical area to watch, as a break below could validate the bear flag and trigger a more significant correction.
So after analyzing these different perspectives, a clear theme of caution emerges.
Both analysts agree that Bitcoin is in a fragile position, expecting a significant price drop before any sustainable rally. They see the Federal Reserve's difficult position and recent price action as major headwinds, suggesting this is not a true bottom. The key divergence lies in their methodology. Ben Cowen arrives at his conclusion through a long-term macroeconomic lens, citing late-cycle indicators. CryptoRover uses short-term technicals, pointing to a bear flag and liquidity pools below. The big question is whether macro forces or technical patterns will break first. The key takeaway? Despite different paths, both lead to the same destination, a high risk of downside in the near future.